Have you ever pondered the impact of elections on the stock market? It's an intriguing question, isn't it? Elections are a fundamental part of democratic societies, but their influence on the stock market is a topic that sparks considerable debate. Over the years, the stock market has shown a pattern of performance before and after elections. For instance, the average return in the month prior to elections is 6%, while the year before elections shows an average return of 29.1%. Take a look at the Lok Sabha results from the past 2 decades. The one-month return before the 1999 election was a staggering 50.7%. However, the one-month return after the election was a negative 0.8%. This trend of a decline in return after the election is consistent, except for the year 2009, which saw a rise of 6.8%. On average, the one-month return after the election is a negative 0.2%. But, interestingly, the average 2-year return after the election is a promising 41.1%. This implies that despite the initial volatility around election times, the market tends to stabilize and even grow in the long run. So, which sectors generally outperform or underperform during elections? The data suggests that the pharma and auto industry perform well after the election, while the IT and metals sectors tend to underperform. Similarly, different investing strategies yield varied results. The alpha strategy tends to give the highest returns, while dividends and volatility strategies consistently provide positive returns. Quality, momentum, and value strategies yield modest returns. It's a common misconception to think that the stock market is solely dependent on elections. Different governments implement various changes that lead to favorable results in their eras while obstructing others. Now let's turn our gaze to the upcoming 2024 Indian elections. According to one of the biggest research houses, there is a high probability that the existing administration will secure a commanding majority, resulting in a market gain of 0 to 5% in the next 3 months. However, another research analyst suggests a 10% chance of the BJP losing in 2024, predicting a 25% market correction. The worst-case scenario, where the leading party secures fewer than 200 seats, may cause a slump lasting up to 40 quarters. But, regardless of the party in power, India's economy will generally continue in its pro-growth trajectory, with an emphasis on infrastructure, productivity-boosting reforms, maintaining market-driven economic policies, and strengthening the economy's resistance to political changes. To put things into perspective, since 1980, the government has changed 11 times, yet the average real GDP growth is 6.2%, and Sensex gave 15.5% CAGR returns. In conclusion, elections do have an impact on the stock market in the short term, causing volatility and uncertainty. However, in the long run, the market tends to stabilize and grow, irrespective of the election results. Therefore, investors need to be patient and not make hasty decisions based on short-term market fluctuations.